Hello everyone, again this is Antonio and I'm coming at you with another exciting video. In this video, I want to talk about my Forex journey part 3. To learn Forex, you have to know the following terms. So, I have learned some terms as I start dealing, like I said in my other 2 videos, dealing with my mentor. He started teaching me the following terms, and hopefully, if you're on this journey with me, these terms may help you as well. Alright, so what I had to start learning is about the currency pairs. There are 180 recognized currencies in circulation being used in 195 countries. As traders, we can speculate on the performance of a certain currency by using a range of analysis and research to determine how that currency will perform in the marketplace. But my chart covers the major currency pairs. So there are 8 major currency pairs that I'm learning, and I'm gonna break it down. The currency pairs is basically that is the pound USD. So the GBP is basically saying the British pound USD, and that nickname is sterling or cable. Then you got the Euro USD, which is the nickname is Fiverr. Then you have USD and the Swiss franc, and that's called the Swissy. You have the USD CAD, which is USD CAD, is Canada, and that nickname is the Loonie. You got the Australian dollar versus the USD, and that is called the Aussie or Oz. And then you got the New Zealand dollar and the USD, that is called Kiwi. You have the British pound and the Japanese yen, and that nickname is Guppy. And then you have the Euro pound, and that nickname is Shunno. So these are the type terms that you're going to start using as you go on this journey. I speculate that this journey, for me to fully learn Forex, probably will take me a year or 2. And I know a year or 2 is a big gap, but it all depends on how much I want to put into the Forex journey. But I definitely want to be on this journey. So let's keep going. All right, let's talk about leverage. This is a term that I'm learning about in the Forex market. Leverage is, in a sense, borrowed money from within a trading account. Trading with leverage allows a trader to open a position with a high contract size with less expenditure. High leverage trading is an effective way to trade your favorite Forex pairs, cryptocurrencies, and much more without investing vast amounts of capital. Let us use a popular Forex pair as a case study and use the British pound and the USD. Based on a contract size of 100,000 per lot, a trader without using leverage will need around $130 million. So basically, what I'm learning from looking at the videos and learning about terms, leverage allows you to have less money into your trading account, but with leverage, it gives you a higher purchase power. So 2 to 1 leverage is a capital invested 1,000, purchase power is 2,000. Money value of 1% profit is 20, and the ROI is 2%. And then you see the chart, the 10 to 1, 50 to 1, 100 to 1, 150 to 1, 200 to 1. And it just all depends on which type of leverage you have before you execute your trade. All right, let's talk about percentage and point. And that's another way of saying pips. So, the candlesticks that you might see on different graphs are considered as pips. And you see the Euro, the USD. Normally it's the fourth number outside of the decimal point will be the pip. So basically 1.14988 and 1.14998 is 1 pip. The only thing is the only trading power that's 3 digits after the decimal point is the Japanese yen. That's always 3. So I'm learning, and that may actually confuse me as I'm going forward, but I'm confident that I will learn. And the acronym PIP stands for percentage and power. PIPS is the smallest movement reflected in an exchange rate on a currency pair. The PIP is the fourth decimal on a price quote for a currency pair. It is used to measure value. For example, the price quote is 0.6876. That means that $1 will be enable you to buy about 0.6876 US dollars. If the PIP increased by 0.0001 to 0.6877, that would mean that you could acquire slightly more dollars for every $1. I know it sounds confusing. I'm on the journey to learn though. All right, let's talk about bid and ask price. The bid price is the price a trader is willing to sell a currency pair. The ask price is the price a trader will buy a currency pair. These prices are displayed on the left-hand side of a MetaTrade 4 in the Market Watch section. The direction between the bid and the ask price is known as the spread. So you can look at the little chart that I put in, in my slide, so you can have a better understanding of what I'm saying. Bid, let's just use the one in yellow, is 2081.25. The ask is 2081.50. So that's the difference in bid and ask. All right, let's talk about going long or going short. When a trader is going long on a currency pair, the first part of the pair is bought while the second is sold. Going long or buying a currency means that you expect the price to rise, i.e. UAD, which is the Australian dollar, versus the USD, which is the US dollar. Buying the Australian dollar against the US dollar is expecting the price of the Australian dollar to rise. When a trader is going short, the first currency is sold while the second currency is bought. Going short is selling one half of a currency pair in the hopes that the price will decrease. All right, let's talk about lot size. Name lots, numbers of units. Standard 1, mini is the 0.1, micro is 0.01, and nano is 0.001. So the standard is 100,000, the mini is 10,000, the micro is 1,000, and the nano is 100. A lot in forex trading is the size of trade position that you will open. One lot in standard forex trading on a currency pair is equivalent of 100,000 units of the base currency of the pair. If you look at the Euro USD, that means that to open a trade in USD will mean that the trade size is 100,000. Euro being the base currency, one standard pip is worth $10. This means that 10 pips incremental movement in the buy trade, that this would represent $100 gain. You will see this again on your journey in Forex. All right, let's talk about bullish and bearish. Market settlement gives a view of the performance of a particular market or the stock market overall. When the market settlement is bullish, this means the price is going up. When the market settlement is bearish, it means the price is going down. An easy way to distinguish the difference is that the bulls have horns and tosses things in the air. When provoked, prices rising. When the bears are provoked, they get on their hind legs and tear things down. Prices decreasing. So basically, I just wanted to just follow up some of the terms that I'm learning on my journey. I want to keep this journey going. Soon, once I learn more, then I'll be able to execute a trade. I just don't want to just stop throwing money in the wind just because you got money. I definitely want to be in this game to win. So once again, thank you for following my other two videos talking about my journey into the Forex market. And I just want to just keep this trend going as far as talking about everything I'm learning. And soon I will be After I learn a little bit more, I'll be execute my first trade. So once again, this is Antonio, and thank you. Please like and comment if you have any similar journey as mine, learning everything that you can about Forex so you can execute your trade. And once again, I will see you next time.